Hello and welcome to the Mutual Fund Show. My name is Neeraj Shah, and these are exciting times simply because the world markets and the Indian markets are doing a thing of their own. Most people are confessing that they are unable to predict the nature of the market currently. But maybe it's times like these that give you opportunities to create serious wealth if you indeed invest in mutual funds. Though it could well be said that maybe this is not the right time, and if you are able to time the market, then maybe sometime later might be the right time. Well, who knows? Well, maybe a couple of our guests who are joining us today on the show know this because they've been doing this day in, day out for a number of years. Regulars on the show, and both of them out here to give you advice. We thought Vijai, Mantri and Sunil, Jhaveri to get both of you together because times like these probably require the best of advice from two very astute people, and therefore the idea of getting both of you together on the same show. Vijay, let's start off with you. Do you reckon that this volatility might be here to stay, but that might actually give you the reason to invest into mutual funds currently? Why or why not?
The volatility has always been and will remain the part of equity investing. And this is not the first time, and this is not going to be the last time. We have seen historically in 1992, we have seen in year 2000, we have also seen in year 2008, where equity has come down as low as more than 50%. So your 10 lakh invested has come down to less than 5 lakh, and it happened 3 times. So it is nothing new, and it is not going to be the first time. One of the worst way to invest, but most people do invest, is to look at immediate past return. If the immediate past returns are very good in any asset category, then people tend to invest in that asset category, be it real estate, be it debt, be it gold, or be it equities. And perhaps the worst time to invest is when returns are very good, and the best time to invest in the returns are suboptimal or in negative territory. So purely from that perspective, because we believe that there's a one law in the finance, which is that reversal to the mean. So anything which goes down continuously has to come up. So this is purely from a philosophical perspective. But equally important is from the perspective of, you look at data, what moves the market. It is basically corporate earning, which get reflected in various ratios which people track, whether it's a P multiple or price to book value or dividend yield or yield gap or a market cap to GDP. From all these perspectives, the market is actually in buy zone. So if anybody have a vision of investing perhaps for next 3 to 5 years, and they have at least 1 year cash to meet the contingency requirement, I think this will be a very good time to start allocating equities, money into equities over maybe 3 to 6 month period.
And there are some very nice graphics and data points that Vijay's team has given. Vijay, I'll cut to that as well, but just an opening thought from Sunil before that. Sunil, what's your sense? The last time that we spoke, you were in the Balanced Advantage Fund category. Are you reversing that call now, and are you switching to equities? Why or why not?
Sure. So as we discussed in July and November 2019, both the shows, that we need to move away from the old mantras of buy and hold, sip karo, bhul jao, and do not time the markets. That is coming to haunt us, or it's being proven right currently. What I have been advocating is being the right asset class at right valuation. Valuations were extremely expensive from July 2017 when we gave an exit call, and we were sitting in Balanced Advantage Fund category from then to as late as 23rd of March 2020, which was day before yesterday, when markets collapsed by 4,000 points. That was the first time in last 3 years the green zone, as per my algorithm, the green zone has been achieved on 23rd of March for the first time in 2.5 years. But mind you, the market is at 17 PE. So the question which people have on their minds is, can the markets correct further from here on? Answer is clearly yes, it can correct from here on also. So if you have the history with you, 2008-9, the market PE had corrected to as low as 10.5 or 11. That means there is some gap still possible. Having said that, is this the time to stay away from the market? The answer is clearly no. My algorithm says 80% in equity, which means that you must start shifting from dynamic asset allocation funds back to equity fund on a regular basis. And markets will give you time from now to maybe next 15 days, 20 days, 30 days during this lockdown period what's happening in the US or what's happening in the Indian context on the COVID issues, etc., we will have opportunities to invest on a daily basis. So yes, my call has now been to start switching from DAF back to equity slowly and steadily. Just one reference point, Neeraj. When markets corrected in January 2008 from 21,000 Sensex to 13,000 Sensex in July 2008, that was the yellow zone with 70% in equity as per our algo. Did investors who invested at 13,000 make money? Yes, they also made money because the market valuation was reasonable.
Sure.
So the conclusion here is that we cannot, find the rock bottom and then wait for us to invest, because markets will not give you time to re-enter if you stay away from this market. But if you have invested at reasonable valuation or at cheap valuations, which is the current scenario, then yes, you will make money based on what even Vijay said. A lot of market parameters are in favor of investing. So from now to next 3 years to 5 years, people should make decent returns for investments made during this period. But for that, the investors needed to have cash. I don't know how many are in cash and how many are bleeding. And second thing is that you need to have guts to invest now.
Yeah, well, so with the presumption that people have cash or the salaries coming in, and out of the money that is left after spending for the essentials, because these are trying times, can you invest in equities? And if so, where to invest? Now, before we get to where to invest, gentlemen, this is what we'll do. Vijay, I'll first come to you. There are some data points that you've given us, Nifty returns under normal circumstances and how they vary. And of course, when the yield gap fell to 16%, I think that's the comparison that you're drawing out. What happened to returns as well? Can you tell us the importance of these data points? And then, of course, we will come to where within this large equity landscape do you gentlemen recommend people should go to? Vijay, let's start off with you first on these comparative points that you've mentioned.
See, Neeraj, I'm tracking a market for last almost 25 years, and we have tracked basically 5 data. One is price to earning, second is price to book value, third is yield gap. There is a earning of Nifty and the gap between Nifty earning and the GSEC yield, and we looked at dividend yield, because no single data will give you conclusive evidence, but you have to read all these 4 data in conjunction. So first, if you look at Nifty normally, out of every 1 year rolling return, Nifty has delivered positive return around 70% of time, and 30% of time Nifty has delivered negative return over a 1 year period. But you extend to 3 year period, then around 3 year period, the Nifty has given negative return in 11% of time, and 89% of time Nifty return has been positive. And 5 year plus period, Nifty has actually never delivered negative return if you account for dividend yield as well. But today we are in a situation where if you just go by dividend yield gap story, then currently dividend yields are, in our opinion, again historical low. So from these level, the probability of loss in a 1 year period has come down from 30% to 0.4%, and in a 3 year period, the probability of loss has come down from 13%, 11% to 0.1%. And the negative return range, 1 year negative worst return Nifty has delivered is 57%. That return actually come down to 2.5% only. And in a 3 year period, the 16% negative return come down to 0.6%. These are Nifty return without taking into consideration the dividend yield. Suppose you have dividend yield. So in 1 to 3 years from now, the probability of loss and the quantum of loss is very, very minimal. So in my opinion, the odds of making money in equity currently is in the favor of investor. But how many investors have a liquidity and how many investors have a courage to invest is a big question mark.
Yeah, I think even if people have liquidity, do they have the courage to invest? Because I think the most common question that comes into minds of everybody is that what if it were to correct more? And I reckon that should be done away with maybe. Vijay, just a follow-up there, therefore, and if that is indeed the thesis, that data supports that maybe there could be some upsides based on various data parameters, what should people do? I mean, there's a category of people which is already invested for the last 2-3 years or maybe longer. Should they continue with the current investments? Should they prefer large caps over mid cap funds because large caps typically tend to rally the first? Or should they continue with the mid cap funds as well, because there are a plethora of mid cap funds that got launched and people invested in them in the last 6 to 9 odd months?
So again, Neeraj, I come to where one need to invest. I think multi-cap, mid-cap could be good area to invest, but just to give a very fast answer, more importantly, investor has invested, for instance, in the mid-cap fund which got launched in last couple of years, and most of them are actually in negative territory. But just go back to year 2000 or 2008. At that time, many fund got launched, and the NAV of the fund has come down. I remember in 2000, many information technology fund got launched and the NAV has fallen as high as 80%. But most of these funds has recovered the NAV when the market recovered and over a period of time made money for the investor. So I'm tracking mutual fund for 25 years. Mutual fund, equity mutual fund has never lost money for the investor if the investor has not taken money out at the wrong time, because eventually market recover and the fund's NAV recover. So my suggestion to the investor who has invested and seeing 20%, 30%, 35% perhaps losses in the portfolio to stay. I know it is, people may say that it is our hard-earned money, it is not your hard-earned money, but we have seen the market, it is your hard-earned money, and perhaps you have seen 80%, 90% of the worst case scenario. From here onward, maybe 5%, 10%, maybe 10% more pain you have to tolerate, but the market will revert eventually, and the investors are going to make very good money from these levels. So probability of losses, in my opinion, from these levels are very, very low. So hold your guts, talk to your financial advisor, because these are the time when the investor need to continuously talk to financial advisor. Like you have a coronavirus, you need to continuously consult the medical professional suppose you have any challenges. Similarly, in the given situation, investor need to communicate regularly with the financial advisor, take the assessment of the portfolio and take right call. That perhaps is, in my opinion, the right prescription in the given situation.
Okay. And well taken. So there are different classes of investors, right? Some people like time in the market. Vijay Mantri is saying even if you haven't timed the market, this might be a bad time to time the market and get out. If anything, this might be a good time to time the market and get in, and that is his view. Now, Sunil, whether for your sets of investors who may have gotten out when you told them to get out and are now looking to get back in, there is data to support this theory, right? From amongst the things that you sent us, the kind of returns for the corrections and the rallies since 2000 give ample evidence that these corrections, when bought into, have actually ended up giving spectacular returns.
Absolutely. So I've given you 2 or 3 data points. One was that last week markets corrected by almost 17% within a week, and before the jump on 20th of March. So in last 20 years, which is 1040 weeks, markets have corrected by more than 10% only in 7 calendar weeks. Now that was one of the points which I had shared with you, saying that this kind of a correction is the one where you need to buy into the markets. The other point, the data point which even Vijay has touched upon, is the PE, PB of the markets, which was in January 2018, it was 27.5 PE and 3.73 PB. Currently we are at 17 PE and 2.17 PB, and market cap to GDP ratio again has come so favorable in favor of the investors, which is almost as close to what happened during financial crisis time in 2008-9. So currently your GDP to market cap to GDP ratio should be somewhere close to 54%. And the other ones are whenever their markets have corrected by there were major corrections from 2000 to 2020. There were quite a few of these corrections of 10, 25, 30, 40%, 50% kind of corrections. The average bounce backs have been almost 52% 1 year later and almost 87% 2 years later in terms of the returns for investors who invested during these correction times. So as rightly pointed out, this is not the time to exit at all. That's totally out of the picture as an option for the investors who are still stuck. But if you have the possibility or capability of investing more at the current junctures, or even your own investments will bounce back to the extent of 52 to 87% as what the markets have done in the past. So if you come out at this juncture, you will lose out on the momentum which will happen going forward.
Well, that's a pertinent point. I just want to bring up that chart. Viewers, remember, history may not repeat, but it can certainly rhyme, and therefore the subsequent base formation and the 1 year returns may start maybe next month onwards, may start 3 months later, may start 6 months later. I don't think anybody right now is capable of saying that. Again, I don't think anybody is capable of saying whether the subsequent 1 year return would be 30%, 35%, 50%, 20%, or 70%. I think it's a mug's game to try and guess that. But the point is that the probability of you making positive returns over a slightly longer period, which is a year, year and a half, 2 years, and returns which could range anywhere between 20% to 50, 60, 70%, the probability is high. And I think that's the point that almost everybody is trying to make, not just out here on the mutual fund show with Vijay and Sunil, but even market experts who said that in times of greed, you have to be fearful and sell. In times of fear, you have to be try and greedy and buy, depending on the kind of risk appetite you have. Now, Sunil, sorry, just one follow-up to that. I was asking Vijay as well, the same thing, and I'm asking you, what kind of funds would you recommend currently? Now, I understand you recommending moving out of balance advantage, which is fine, but if people have the cash, or if people have some cash which they want to deploy into, should they use large cap funds, because that's where the first port of call is? Should they use multi-cap funds? Should they use mid-cap and small-cap funds? Should they use something else?
Sure. See, going forward, the fund managers' ability to create alpha in these segments is limited, because now they are capped as far as the SEBI regulations are concerned. And we discussed this during our shows earlier also, that I'm an advocate of multi-cap funds. Rather than taking a call on mid-cap and small-cap yourself, because you do not know when to exit. If you know when to exit out of mid-cap and small-cap, please get into that. But I'm not an advocate or a proponent of that. Get into a multi-cap space, let the fund manager decide whether it should be skewed more towards large cap, more towards mid-cap, etc. And that should have the journey for the investors on a much smoother scale. So large cap, yes, I would do large and mid cap also as a segment, and multi cap. So these are the three segments which I would definitely recommend. Those who want to get into a little more aggressive because of the market valuations at current juncture, up to mid cap is what I will go to.
Okay, so that's the fair assessment. And remember, the idea is to, from both our experts, is to look at equity funds. I just, however, while we're talking about equity funds at large, would want to touch upon the other non-equity category as well. And here, both our experts have had divergent views, and it's completely fine to have that. Actually, it's welcome, because it's multiple views that make the market what it is. Now, Vijay, Mantri, to start off with you, the current debt market situation and the non-equity funds, what do you make of it? What would your advice be to people who also want to park some bit of money into the non-equity funds?
See, I think if you see in the month of March, FIs sold lots of debt paper in India. And because of that, the current yield on commercial paper, CDs, NCDs, even PSUs and AAA bonds has spiked up quite significantly. So the investor may have seen negative return on ultra short term and for a few days maybe on the liquid fund. But compared to bank FD, in my opinion, liquid fund for next 1 month or 2 months will substantially outperform bank FD. Same thing would apply to ultra short term fund. And even if you look at the PSU debt fund, the PSU debt fund currently, the YTM, which was around 6.5%, has gone up to 7.5% to 8%. And in AAA bond, it is above 8%. So if anybody is looking at 3-year plus investing horizon, then in my opinion, post-tax, it will not be very difficult to look at 6.5% to 7% post-tax kind of return from these levels. So it is a fantastic opportunity even on the fixed income side. And Bloomberg wrote a very interesting article, and I quote from that article, even HDFC Limited's commercial paper has shot up from 5.5% to 8%. Bajaj Finance paper has shot up from 5.5% to 7%. Birla Capital, Aditya Birla Capital, CP has gone up from 5.5% to 10%. So these are really mouth-watering yield. And what will happen? Lots of money is going to go into bank deposits. So perhaps banks are continue to go down the path of reducing deposit. So if anybody look at investing, though today the comfort level of banks are very, very high because people are concerned about whether the world will remain there tomorrow or not. But if you are looking at investing anything between 30 days to 3 year to 4 to 5 year, today the top end debt fund provide fantastic opportunity.
Okay, Sunil, what's your view? And your view can be radically different. It's completely fine. What's your view?
No. I'm absolutely on the same page as Vijay.
Okay.
These are the opportunities which, if you remember, we had done one show, Think Debt, Think Long Term. In that, I had mentioned that there will be spikes in the interest rate scenario from time to time. Those are the spikes which are opportunities for any investor to invest in. Will I recommend a credit risk space currently? I'm saying no, because credit risk space, that time also I had spoken against it, and this time also I'm saying the same thing, that in this particular year, there will be still more credits, defaults, delays and downgrades possibility. But there were those AAA rated, as Vijay rightly pointed out, PSU bond funds, which we had discussed on our show also when we said think debt, think long term, have really shot through the roof. I mean, these are the opportunities, and I said that treat them as a open-ended fixed maturity plans. So what I had meant by that was exactly the same situation what we are facing currently, when your yields have gone up from 6.5 to 7.5 or 8% on the AAA rated bonds. Some of the schemes which we had discussed was that Edelweiss Bharat Bond Fund, Axis Dynamic Bond Fund, falling, constantly rolling down maturity, Nippon Nivesh Lakshya, which is on 25-year constantly rolling down on G6, etc. These are the opportunities for anybody to invest and forget that money. If you are following asset allocation strategy, this particular segment of debt at the current level should become your passive debt allocation. Invest in these schemes, forget about it for the next 5 years, 10 years, and do whatever you need to do on the equity side based on valuation. You will be absolutely on track because you're not taking any credit calls, you're not having any liquidity issues with these kind of bonds and schemes, and you have captured higher yields. So what more can you ask for? Because going forward, I don't foresee the yields to remain at these levels for longer periods of time, because the country like India, $20 and below oil is a great opportunity on the debt market. Current account deficit may be in surplus zone. Inflation is under control, and I'm sure RBI in some time in the near future will be coming to cut rates and infuse liquidity. All these are positive factors as far as debt is concerned. Even as Vijay rightly pointed out, your liquid fund, ultra short term, low duration, etc., where there is no credit, are the ideal ones to invest now, hold it for the next 3 months, 6 months also. You will make enough money as far as the debt side is also concerned.
Okay, so 30 seconds each because we are running out of time. But Sunil, I just wanted to recap the funds that you mentioned. There's a Nippon India fund and an Axis fund. Would you just because equity funds, people find it a lot easier to invest into. For debt funds, they get confused because there's so multiple options. There's liquid, there is short term, etc., etc. What are the 1 or 2 options that you believe are good to invest into? Then people will of course make their own research and their own call. But just from your perspective.
But this is for long term, as I'm saying again. So that's the caveat. So Axis Dynamic Bond Fund invests in AAA rated corporate bond funds, and these are all constantly rolling down on maturity. Edelweiss Bharat Bond Fund does something similar where they invest in AAA rated PSU bonds. Edelweiss also has a PSU and a banking debt fund, again a constantly rolling down, no credits there. Nippon Nivesh Lakshya is a 25-year GSEC paper constantly rolling down. And the other one which I would like to add into this segment is the All Seasons Bond Fund of ICICI Prudential, because they have a CAD index and they do duration between 1 year to 10 years based on the macro factors attached to current account deficit. Okay. So these are the 4 of my favorites on a long-term basis. I will continue to repeat them from time to time as and when the opportunities arise. And we will talk about it because the yields have gone up currently. So we are speaking about them again.
Got the point. And of course, viewers, please do your due diligence before you enter into these funds, because they may be good for Sunil, for example, because they invest from a particular time horizon perspective. For you, the time horizons might be different. So maybe talk to your investor, financial advisor. If you don't have one, then try and assess, see this show again, and then take a call about what you want to do. Vijay, last question, out of time on the show, but same question to you. Sorry, yeah, Sunil. Finish quickly, Sunil, 10 seconds.
No, these are the long-term debt funds, so the intermittent volatility will be part and parcel of it. You will need to write that.
Got it. Okay, Vijay, to you, final question. On the debt side, what is it that you would recommend, with caveats, of course, that your viewers will do their own due diligence before investing?
I think look at the time horizon and look at the matching maturity of the fund, and then compare the YTM with the bank deposits. So if you do that, then you'll be very fine. So if you're looking at 30 to 60 days investment, liquid is a great time to invest. If you're looking at 60 to 6 month period, ultra short term is a great product. If you're looking at 1 year plus, then you may look at low duration fund. If you're looking at 3 year plus, then corporate bond fund are the fantastic idea to invest in the current
Which
market PSU funds. But in my opinion, look at IDFC, look at SBI, look at SDFC, look at ICICI Prudential, look at Axis Mutual Fund. These fund houses have done fantastic job in the current market condition, and most of their fund has done very well.
Okay, well, that gives us ample ammo to sit through this weekend as it comes and try and assess where is it that we have surplus money, how much of it should go into equities as our experts are suggesting, and then if you want to make debt as an asset allocation strategy, then these are some options that are available. Gentlemen, Sunil, Jhaveri, Vijay, Mantri, thank you so much. Once again, stay safe. Thanks so much for joining in on this leg of the Mutual Fund Show.
And last but not the least, I wish a very safe and our viewers, Sunil, all your staff should stay safe. And I wish that everything will be over in maybe 21 days time, and perhaps we'll meet again. Thank you very much.
So stay home, stay safe. That's the mantra.
Yeah, stay home, stay safe, and let the money work for you. That's the mantra. Gentlemen, both of you, thanks so much for joining in. And viewers, we can't emphasize this enough. With this Wednesday is the first day of the 21-day lockdown. Please don't get deterred. Stay home, stay safe. Don't spread the virus. Spread good wishes and earn money. Thank you so much for joining in on the Mutual Fund Show.